So, you want to become a consistently profitable trader. Here's the thing. Many traders lose money because they are looking at the wrong charts at the wrong time. They get stuck on the 5-minute chart, trying to catch every little move, but they have no idea where the market is actually going. This is like trying to navigate the ocean in a small boat without a map or a compass. You will get tossed around by the waves and end up lost. To fix this, you need a proper trading plan, and it all starts with looking at the bigger picture. This is why we combine the daily and hourly charts. The daily chart is our map, showing us the main direction, while the hourly chart helps us find the perfect time to get on board. This approach is powerful because it keeps you on the right side of the market. The big banks, hedge funds, and institutions are the ones who move the markets. They are not trading on the 1-minute chart. They are making decisions based on longer-term analysis, which creates powerful trends that you can see clearly on the daily time frame. By starting your analysis here, you are aligning yourself with these major players. You are no longer fighting the current, you are flowing with it. This simple shift in perspective can dramatically improve your trading results and reduce your stress levels, because you are not trying to guess every little up and down tick. Think of it like being a sniper. A sniper doesn't just start shooting randomly. First, they find a high vantage point to survey the entire battlefield. They identify the direction of their target and wait patiently for the perfect moment. For us as traders, the daily chart is our high vantage point. It allows us to see the entire battlefield clearly. We can identify the main trend, locate the key areas where battles between buyers and sellers are likely to happen, and wait for the market to come to us. This patience is a professional trader's greatest weapon, and it all begins with understanding the story the daily chart is telling you. So, let's make a commitment. Before you even think about placing a trade, you will always start on the daily chart. No exceptions. This is the foundation of our entire strategy. It is the first and most crucial step in building a robust trading business. By doing this, you filter out the market noise and focus only on high-probability opportunities. You gain clarity and confidence because your decisions are based on a solid, logical framework. Forget about the noise on the lower time frames for now. Our journey to mastering this Forex strategy begins with mastering the daily chart first, which is what we will cover next. Now, let's get practical. How do you actually use the daily chart to find your trading opportunities? The first thing you must identify is the market trend. This is simple. In an uptrend, the market makes a series of higher highs and higher lows. Think of it like walking up a staircase. Each step is higher than the last. In a downtrend, the market makes a series of lower highs and lower lows, like walking down a staircase. You can simply look at the chart structure to see this. If you want, you can also add a 200-period exponential moving average, or EMA, to your chart. If the price is consistently above the 200 EMA, the long-term trend is likely up. If it's below, it's likely down. Once you know the trend, the next step is to find key market structures. These are your major support and resistance zones. Support is an area on the chart where buying pressure is strong enough to push the price up. Think of it as a floor. Resistance is an area where selling pressure is strong enough to push the price down. Think of it as a ceiling. You can find these areas by looking for places where the price has turned around multiple times in the past. Mark these zones on your chart with a horizontal line or a rectangle. These are the key areas where you will be looking for trading signals, because this is where the big players are likely to make their moves. After you have marked your zones, you need to wait patiently for the price to reach one of them. This is very important. We do not trade in the middle of nowhere, because there is no edge there. We only want to trade from these predefined areas of value. For example, if the market is in an uptrend, you want to see the price pull back to a major support level. This is where buyers who missed the initial move might be waiting to get in. You are essentially looking for a discount in an uptrend, and these support zones are your sale price locations where you can buy low with the trend. The final clue you look for on the daily chart is a candlestick signal. When the price reaches your key support or resistance zone, you want to see evidence that the market is respecting that level. A powerful signal is a rejection candlestick, like a pin bar or a hammer. This looks like a candle with a long wick and a small body. A long lower wick at a support level shows that buyers stepped in and rejected lower prices. A long upper wick at a resistance level shows that sellers rejected higher prices. Seeing this on the daily chart is a very strong sign that the level is holding and the market might be ready to move in your intended direction. So you have done your homework on the daily chart. The market is in a clear uptrend, the price has pulled back to a major support zone, and you have just seen a bullish rejection candle, like a hammer. The big picture looks good. Now, and only now, do you have permission to zoom into the hourly or H1 chart. What is the purpose of this? We use the hourly chart to fine-tune our entry. It gives us a closer look at the price action and helps us find a low-risk entry point, so we can get into the trade before the big move happens and improve our risk-to-reward ratio. This is how you combine the strength of the daily trend with the precision of a lower time frame. On the hourly chart, your job is to look for confirmation that the buyers are indeed taking control, just as the daily chart suggested. You are looking for classic chart patterns that signal a reversal of the short-term pullback. One of the most powerful patterns to look for is an inverse head and shoulders pattern at a daily support level. Another strong signal is a double bottom, where the price fails to break a low twice and starts to move up. You can also look for a simple break of a minor resistance level or a trend line on the hourly chart. When you see one of these patterns forming, it's a huge confirmation that the daily support is holding strong. Candlestick patterns on the hourly chart provide the final piece of the puzzle. As the price action develops near the daily support zone, watch for strong bullish candles. A bullish engulfing pattern, where a large green candle completely covers the previous red candle, is an excellent signal. This shows a powerful shift in momentum from sellers to buyers. You might also see a series of smaller bullish candles forming, showing that buyers are slowly but surely gaining control. Seeing these candlestick signals within a larger bullish chart pattern on the hourly chart gives you a very high probability setup to trade with the daily uptrend. Remember, the hourly chart is only for entry confirmation. You are not looking for a new trend on this time frame. The daily chart has already told you the direction you must trade. Your only job on the hourly chart is to answer one question. Is now the right time to enter in the direction of the daily trend? If you see the price at a daily support level and the hourly chart forms a double bottom followed by a bullish engulfing candle, the answer is a clear yes. This systematic approach removes guesswork and allows you to enter the market with a high degree of confidence. You have found the perfect setup. The daily trend is up, the price is at major support, and the hourly chart has given you a beautiful entry signal like a double bottom. It is now time to execute the trade. Your entry point should be at the break of the confirmation pattern. For example, if you spotted a double bottom on the hourly chart, you could enter the trade as soon as the price breaks above the neckline or the small resistance level between the two bottoms. By waiting for this break, you are confirming that the buyers have enough strength to push the price higher and that the pattern is valid. Don't jump in too early. Let the market prove you right first. Next, you must define your risk by setting a stop loss. This is not optional, it is your insurance policy. If the trade goes against you, the stop loss protects you from a large loss. A logical place for your stop loss is below the key level you are trading from. In our uptrend example, you would place your stop loss just below the low of the double bottom pattern on the hourly chart. This gives the trade some room to breathe, but ensures that if the daily support level truly fails, you are taken out of the trade with a small manageable loss. Never trade without a stop loss, ever. With your entry and stop loss set, it's time to think about your profit target. Where will you take your profits? A great place to set your take profit is just before the next major resistance level on the daily chart. Look back at your daily chart analysis and identify the next ceiling where sellers might step in. Aiming for this level ensures you are capturing the bulk of the move. You should always aim for a risk-to-reward ratio of at least 1 to 2. This means that for every dollar you risk, you are aiming to make at least $2. This ensures that even if you only win half of your trades, you can still be a profitable trader over the long run. Finally, the most important part of this strategy is discipline. Once you have your plan, you must stick to it. Do not enter trades in the middle of a range. Wait for the price to come to your predefined daily zones. Do not get tempted by random moves on the hourly chart if they are not supported by the daily picture. The key to long-term success is not finding a secret indicator, but consistently executing a simple, logical plan like this one, day in and day out. Trust your analysis, manage your risk, and let the market do the rest. This is how you trade like a professional.